What's up, guys? John here. The 5 biggest banks in America have just fired 20,000 employees quietly.
Big banks have been quietly cutting jobs, and more layoffs could be coming.
If you look at these 5 banks, they've cut about 20,000 jobs so far this year. Wells Fargo is the biggest sort of perpetrator here. They've cut about 11,000 jobs, or about 5% of their workforce, just this year alone.
They didn't let any of this out to the media. People had no idea. Everyone was anticipating a soft landing.
I do continue to believe that there's a path to a soft or a softish landing.
A soft landing is a primary objective, and I did not say otherwise.
The big question is, why would 5 of the biggest banks in America lay off 20,000 employees quietly? Well, it's because they're bracing for impact. They see exactly what's coming, and we're walking into something that I believe is going to be far greater than the Great Financial Crisis. This isn't an opinion. It's just looking at the data, looking at the facts, looking at where consumers are, looking at where this economy is, looking at where the world is. We're in different times than we were in 2008, and in this video I'm going to break down exactly what's going on. Please hit the like button. YouTube will share this content to educate other people about what's really going on. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com, book a free strategy session by clicking the link below in the video. Take a look at this. Big banks are quietly cutting thousands of employees, and more layoffs are coming. The next 5 largest U.S. banks cut a combined 20,000 positions so far this year. More to come. More are going to come. So look at this. The largest American banks have been quietly laying off workers all year, and some of the deepest cuts are yet to come. Even as the economy has surprised forecasters with resilience, lenders have cut headcount and announced plans to do so, with the key exception being JP Morgan Chase, the biggest and most profitable bank in the U.S. Well, the reason for that is because they're going to be able to acquire more and more financial institutions. They're going to continue to grow their headcount as they start to buy up all these banks. They bought one big one, 6 months ago, 5 months ago. They're going to buy more, I promise you. Pressured by the impact of the higher interest rates on the mortgage business, Wall Street deal making, and funding costs, the next 5 largest banks have cut a combined 20,000 positions so far this year. The move comes after a 2-year hiring boom during the pandemic. The big question is, are banks walking into big problems? Well, this article came out today. Jerome Powell says inflation is still too high and lower economic growth is likely needed to bring it down. What does that mean? It means that interest rates are going to continue to move up. They're going to stay higher for longer, meaning consumers are likely going to be walking into a world of hurt, which is not going to be great for a lot of the investments that these banks made, their commercial real estate holdings. The deposits in which they invest are going to continue to get evaporated. More pressure is going to be put on these banks. More consolidation is on the way. No doubt about it. The move comes after a 2-year hiring boom during the pandemic, fueled by a surge in Wall Street activity that subsided after the Federal Reserve began raising interest rates last year to cool an overheated economy, and banks found themselves suddenly overstaffed for an environment in which fewer consumers sought out mortgages and fewer corporations issued debt or bought competition. So look at this. Deepest cuts. You have Goldman Sachs. Meanwhile, after several rounds of cuts this year, Goldman executives said that they had the right size the bank, and they don't expect another mass layoff like the one enacted in January. But headcount is still down at the New York-based bank. Last year, Goldman brought back annual performance reviews, and people deemed low performers are cut. In the coming weeks, the bank will terminate around 1% or 2% of its employees. Headcount will be also drifted lower because Goldman pivoted away from the consumer finance. The firm agreed to sell 2 businesses in deals that will close in the coming months. And I think the reason they're probably pushing away from consumer finance, they know consumers are in big trouble, and they're going to continue to see these defaults continue to mount. Look at consumer saving rate right here, and then you look at this right here. Credit card losses are rising at the fastest pace since the GFC, the Great Financial Crisis. One of the big key differences in the GFC when it comes to credit cards is that the average interest rate on a credit card back then was 12.05%. Now, average interest rate, 28.05%. Consumers are in an inflationary environment with record high interest rates. These credit card debts are going to continue to mount as we walk into the holidays. Think about it. You have 43.5 million Americans owe student loans October 1st, right? About 2.5 weeks ago. We're walking into the holiday season. People are going to rely more on their credit cards. They're going to travel. They're going to buy gifts. And they're going to walk into a situation where the job market is continuing to soften, and they're going to start defaulting left, right, and center, all of which is going to be the responsibility of these financial institutions. So they know what's coming. And that's why Goldman I believe, stayed away from it. A key factor driving the cuts in the job hoping is the finance slowed drastically from earlier years, leaving banks with people that they have expected. Look at this. So Citibank right here. While Citibank staff figures have been stable, some 240,000 this year, there are significant changes afoot. CFO Mark Mason told analysts that the bank had already identified 7,000 job cuts linked to 600 million in reposition change charges. 600 million. CEO Jane Frazier's latest pace, the overhaul of the bank's corporate structure, as well as sales overseas and operations, will further lower headcount in the coming quarter. Then you look at other banks as well. Like, you have all of this restructuring happening. I believe what's going to happen is we're going to see these big banks continue to restructure their employees simply because they're going to have less revenue coming in, and artificial intelligence and technology is going to play a major role in banking and finance in the coming years. There's no doubt about it. But when they say these headlines, inflation's still too high, you have to remember that inflation is directly tied to energy prices. And what's going on with Israel and Hamas and Russia and Ukraine and everything that we're involved in right now, what's ultimately going to happen is our energy prices are going to continue to rise. So they're acting as though they can continue to increase interest rates, and that's going to offset oil prices. It makes no sense. We're going to walk into a situation where liquidity is going to continue to tighten and the cost of the world is going to get more and more and more expensive. But they don't tell you this in the media. What they say is, we need to hike rates just one more time. We need to, pull back spending. We need to really solve this problem because of what happened during 2021 and 2022. It's nowhere near the relevant truth. Federal Reserve Chairman Jerome Powell acknowledged recent signs cooling inflation, but he said Thursday the central bank would resolute in its commitment to a 2% mandate. 2%. Imagine that. Do you think that's actually going to happen? Many people would argue that real inflation is 18%. Not 3% or 4% are the numbers that they're providing. So they're saying a 2% mandate. This means that we're walking in to a hell of a hard landing. In a widely anticipated speech delivered by the Economic Club of New York, Powell evaded committing to a specific policy path, but gave no indication that he was leaning towards a push for interest rates. As Powell spoke, futures market traders erased any possibility of a rate hike in November and decreased the chances of a move in December. He acknowledged that the progress he made towards bringing inflation back down to a manageable level, but stressed vigilance in pursuing the central bank's goals. Inflation is still too high, and a few months of good data are only the beginning of what will take to build confidence that inflation is moving down sustainability towards our goal. Powell said in a prepared remark, "We cannot yet know how long these lower readings will persist or where inflation will settle over the coming quarters. While the path is likely to be bumpy and take some time, my colleagues and I are united in our commitment to bringing inflation down substantially to the 2% range." I mean, do you actually believe this? Honestly, I don't think that anyone in America right now is looking at inflation and saying, we're at 2% or we're at 3% or 4% and we're going to actually be able to achieve this. We're walking into a situation that I think is going to be far worse than the great financial crisis. I believe that many people are on that same page. Last year, a lot of people thought that that was crazy. It was never going to happen. We're not going to walk into a GFC type of situation. But remember, the GFC, at that time, wages were not that far from where they are now, and home prices, the average home in America was somewhere around 250 grand, 225 to 250 grand. Now the average home in America is 420 grand. A used car in 2008 was $7,900. The average car payment right now is $740. So for context, if you were to make your average car payment of $740 over a 60-month loan term, you could buy 4 cars with that same payment, what you could buy a used car for in 2008. Think about what food prices were. Think about how everything has changed. Back then, it was mainly just a housing crisis. It was mainly just a banking crisis. We're walking into now is an energy crisis. We're walking into a leveraging, we're just walking into a crisis across the board. Homes are in more debt than ever before. They're in a situation in which their jobs have never been questioned like they're being questioned now. We're walking into a major overhaul of the U.S. economy. Banks know it. Banks have the information. They have the data, the real information. They're laying off 20,000 people so far quietly this year. There's a reason for it. If we were walking into a soft landing, do you think they'd be laying off 20,000? Or do you think that they would probably be gearing up to start to acquire more assets? And they thought the consumer was going to come back to life. They know the consumer is in big trouble. Ken Griffin, the CEO of Citadel, the wealthiest hedge fund manager in the world said that we are walking into a situation where consumers are going to run out of money by the end of the year. He said it. He said it. They're all in the same team. They're all in the same club. They're all laying off people. They're all preparing for a major rug pull of the U.S. economy for a reason, because the data suggests it. It's not, fear mongering. It's the fact. That's what's actually happening. They know that we're walking into a very, very, very big problem. And no interest rate situation that Jerome Powell has control over is going to change this. That's the hard, real fact. So you want to position yourself. If banks are firing 20,000 people, if the biggest guys in the room are all doing the same thing, you want to ask yourself why. You want to position yourself with cash. You want to study your local real estate market. You want to build out a game plan and a strategy to buy deals, to put yourself into a strong financial position as this economy goes through a hell of a beating, I believe, over 2024 and 2025, as $1.5 trillion in commercial real estate debt has to get refinanced next year alone, $2.7 trillion over the next 3 years. Big banks and regional banks are holding all that debt, knowing that they're about to take a massive loss across their entire portfolio, and somebody's going to buy those properties. I believe it's going to be the big private equity firms, institutional investors, hedge funds, syndicators. A lot of people are going to start making a lot of money. A lot of people are going to lose a lot of money. The big question is, which team are you going to be on? Big money, big opportunities coming. Hit the like button below, and if you want to fix your credit, we'd love to help you. Hit the like button, and GreatCreditFast.com. GreatCreditFast.com. Schedule a free strategy session below. I'll catch you in the next one.